Welcome to the deep dive. You know how we do it. We take the complex topics, the research, the articles you send us, and we break it all down. Just the knowledge you need, no fluff.
And today, well, we're jumping right into maybe the biggest financial worry for a lot of people right now.
Yeah, it's that feeling that the anchor, the safe part of your investments, isn't really holding anymore.
Exactly. It's a huge anxiety, especially if you've always followed that time-tested investment advice. People near retirement or in it, they're feeling this.
We have to just say it up front. The bond part of the classic portfolio, it just hasn't worked lately. It's failed us.
It really has. I mean, the whole point of the traditional 60-40 setup, that blend of stocks and bonds.
60% bonds, 40% stocks, or sometimes the other way around.
Right. The specific mix varies, but the principle's the same. Bonds were meant to be the ballast, the steady income provider, especially when stocks got choppy.
But that's not what we've seen, is it? Interest rates shot up aggressively. And what happens then? Bond prices fall. They plummeted. So instead of a cushion, investors saw negative returns even after accounting for inflation across their safe assets.
And that's huge.
Yeah.
Because the whole idea relies on them not moving together. When stocks go down, bonds are supposed to go up, or at least hold steady.
That non-correlation.
Exactly.
Yeah.
When that breaks down, when your safety net starts losing money at the same time as your growth engine, well, the whole risk management idea kind of falls apart.
It forces you to rethink everything, doesn't it? Those fundamental ideas we've relied on for decades.
It absolutely does. Which brings us to our mission for this deep dive.
We're taking on what you might call the most sacred cow in investing, the traditional Boglehead portfolio.
Named after the great Jack Bogle, of course.
We're putting it under the microscope, testing it head-to-head against a very specific, let's say provocative alternative, one that's been showing much higher returns lately. We're calling it the modern mix.
And let's be super clear about the specific setups we're comparing. The Boglehead strategy we're using as the benchmark is a fairly common one, maybe a bit conservative, often used by retirees. 40% in VTI.
That's the Vanguard Total Stock Market ETF, covers basically the entire U.S. stock market.
Right. And the other 60% in BND.
Vanguard Total Bond Market ETF, the classic bond anchor.
That's our baseline. Now, the challenger, this modern mix.
It keeps the 40% VTI. The stock part is the same.
Yes, but it ditches the BND entirely. Instead, it splits that 60% into two different assets. 30% goes into GLD.
The big gold ETF tracks the price of gold bullion.
And the final 30% goes into STRC.
Okay, STRC. That's Strategy Shares NASDAQ 7 Index ETF. Bit of a mouthful. It's often looked at as a sort of high-yield fixed-income proxy, right?
Exactly. It aims for high monthly income using a mix of assets. So it's meant to replace the income from bonds, but potentially deliver a lot more yield.
So we're really comparing apples and oranges here, philosophically speaking.
Completely. The Boglehead way is all about minimizing costs, maximizing diversification across thousands of securities. It's about accepting market returns cheaply and safely.
Predictable stability, almost. Or at least minimizing unpredictable risk.
Right. The modern mix is chasing higher returns, trying to solve today's problems like low bond yields and inflation. But to do that, it brings in complexity, it brings in gold, and crucially, it brings in a very different kind of risk profile with STRC instead of BND.
Okay, that's the setup. So here's the plan for the deep dive. First, we absolutely have to honor the man himself, Jack Bogle, understand his core ideas because they really did change the world for investors.
You can't understand the 60-40 without understanding Bogle.
Then we'll get technical. We'll break down exactly how VTI and BND work, what's inside them, why are they designed that way.
The nuts and bolts.
Finally, the main event. We run the numbers. A simulated 10-year showdown between the Boglehead 40-60 and this 40-30-30 modern mix. We'll see the performance difference.
But, and this is critical, we can't stop at just the returns. We have to do a serious risk assessment. What are the hidden dangers, especially in that modern mix? That's where the real story often lies.
Sounds like a plan. Let's start with the legend. Jack Bogle. Okay, Jack Bogle. John C. Bogle, where do you even start? He wasn't just some fund manager. He was, like, a genuine iconoclast. A revolutionary, really.
He absolutely was. And his philosophy, the Boglehead way of thinking, it's still incredibly powerful today. It wasn't just about making investing cheaper. It was almost a moral crusade.
Taking power back from Wall Street.
In a way, yes. Giving it back to the everyday person, the small investor. And it all stemmed from this one incredibly powerful insight he had after years working inside the mutual fund business.
Which was?
Costs. Simple as that. He looked at the numbers, analyzed fund performance over a decade, and realized the single biggest thing holding investors back wasn't bad stock picks. It was the fees they were paying. Costs were the enemy.
It sounds so obvious now, maybe. But back then...
Back then, the whole industry was built on high fees, active managers promising to beat the market, complex strategies. Bogle said, wait a minute, look at the math.
Yeah, talk about the math. A 1% or 1.5% fee doesn't sound like a lot year to year.
Right. But Bogle showed how it compounds over time. Let's say the market gives you, I don't know, 10% a year before fees. If you pay 1.5% in expenses,
that's 15% of your return gone right off the top.
Every single year. Over 30 or 40 years of investing, that seemingly small fee can eat up a third, maybe even half, of your potential nest egg. It's devastating. Bogle called it the tyranny of compounding costs.
Tyranny. Strong word.
But accurate. He realized something crucial. Predicting which star manager would outperform next year. Almost impossible. Luck plays a huge role. But costs. Costs are predictable. They're guaranteed.
So if you can't control market returns, control what you can control.
Exactly. Minimize friction. Reduce those fees to the absolute minimum. That became his obsession. It was a guaranteed way to improve your odds to keep more of the market's return for yourself.
And this wasn't just theory. He put it into practice, but it wasn't exactly a smooth ride for him initially, was it? The founding of Vanguard.
No, not at all. There's a great story there. He was actually fired from his job at Wellington Management in 1974. There was a merger he'd pushed for that went badly.
Ouch. Getting fired usually isn't a great career move.
Right. But for millions of investors, it was maybe the best thing that could have happened. Because he took that setback, that professional knock, and doubled down on his core belief. He founded the Vanguard Group.
And built it differently from the ground up. That structure is key, isn't it?
Absolutely critical. It's totally unique in the financial world, even today. Vanguard isn't a public company trying to maximize profits for outside shareholders.
So who owns it?
This is the genius part. Vanguard is owned by its own funds.
Okay.
Which, in turn, are owned by the investors in those funds. So if you own a Vanguard ETF like VTI or BND, you are indirectly one of the owners of Vanguard itself.
Wow. So the company's goal isn't to make profits from you, it's to serve you at the lowest possible cost.
Precisely. The conflict of interest just vanishes. The owners, the fund shareholders, benefit directly when Vanguard cuts costs. It's structurally designed to drive fees down relentlessly.
That structure was the perfect foundation for his big idea, the index fund.
The index fund for the masses. In 1976, Vanguard launched the first index investment trust. It was designed to just track the S&P 500 index. No fancy stock picking, no star managers, just own the market.
And how was it received? Parades down Wall Street?
Hardly. It was mocked viciously. They called it Bogle's folly. Un-American, even. The idea of settling for average returns seemed ridiculous to the establishment, who were all selling the dream of beating the market.
It barely raised any money at first, right?
Very little. But Bogle stuck with it because the logic was sound. Index funds didn't try to beat the market. They were the market, minus tiny costs.
Oh, over time.
Over time, the math won. Most active managers, after their high fees, failed to consistently beat the simple, low-cost index fund. Bogle was proven right, spectacularly so.
And that success led to this whole Boglehead philosophy. If you had to boil it down, what are the core commandments?
They're beautifully simple, really.
Okay.
1. Use low-cost index funds. Forget expensive active managers. Costs matter most.
Got it.
2. Diversify broadly. Don't make big bets on single stocks or sectors. Own everything.
Makes sense.
3. Keep it simple. Complexity usually just adds cost and confusion. Stick to basic, understandable strategies.
Right.
And 4. Stay the course. Think long-term. Ignore the market noise, the panics, the fads. Don't try to time the market.
Low cost, broad diversification, simplicity, long-term focus. That really does explain why something like a 60-40 or 40-60 portfolio became the standard Boglehead approach.
Exactly. A mix of broadly diversified stocks, like VTI, for growth, and broadly diversified high-quality bonds, like BND, for stability and income. Low cost, simple, captures broad market returns.
It's all about prudence, managing risk, preserving capital, and for decades it worked incredibly well. It gave people stability, growth, peace of mind, all at minimal cost.
It did. Which brings us right back to today's problem.
The bonds. The anchor isn't holding like it used to.
That recent pain, that poor performance from BND, is forcing this uncomfortable question. Is the classic Boglehead model, this sacred cow, still the best approach for everyone, especially in this environment?
Which is why we have to compare it to the modern mix.
Yeah, we're pitting Bogle's philosophy Minimize cost, maximize diversification, avoid specific risks against this other strategy, the modern mix, which deliberately takes on different kinds of assets like gold and STRC.
Assets chosen specifically to maybe give better returns or inflation protection than BND has recently.
Right. But in doing so, it sacrifices that extreme diversification and introduces potentially huge concentrated risks that Bogle would likely have found, well, horrifying.
So it's not just about which one made more money in the last 10 years. It's about understanding the trade-offs, the risk you're taking to get those returns.
Exactly. The Boglehead way is designed to prevent disaster, even if it means lagging sometimes. The modern mix aims higher, but you have to ask what happens if its components fail.
Okay, so we've got the Bogle philosophy clear. Now let's pop the hood. Let's look at the actual engines of the Boglehead portfolio we're testing, VTI and BND.
Right. These are the building blocks. Understanding what they are and how they work is crucial before we compare performance. They really are marvels of financial engineering built for scale and efficiency.
Their whole purpose is just to mirror their respective markets, U.S. stocks for VTI, U.S. bonds for BND as cheaply as humanly possible.
That's the goal. Let the market do the work. Keep your costs near zero.
Let's start with VTI, Vanguard Total Stock Market ETF. In our Boglehead simulation, this is the 40% allocation. This is the growth engine.
It really is. When you buy VTI, you're basically buying a tiny slice of the entire investable U.S. stock market. You're making one big bet that American business overall will grow and create value over the long haul.
Not just Apple, not just Google, not just the big guys.
Nope. Everything. From the mega corporations down to much smaller companies, it's the ultimate diversification play within U.S. stocks.
So what's the index it actually tracks? How does it achieve that total market coverage? Is it different from just, say, an S&P 500 fund?
Good question. It tracks the CRSP U.S. Total Market Index. Now, the S&P 500 is just the 500 largest U.S. companies. It's large cap focused.
Okay.
The CRSP index, though, goes much, much broader. It aims to cover essentially 100% of the investable U.S. stock market. We're talking large cap, mid cap, small cap, even micro cap stocks.
How many companies are we talking about?
Over 3,500 different stocks, maybe closer to 3,600 sometimes. It fluctuates a bit.
Wow. So way more diversified than just the S&P 500. Why is including all those smaller companies important?
Well, a couple of reasons. First, pure diversification. You're capturing the entire market return, not just the large cap slice. Second, history shows that small cap stocks sometimes outperform large caps for extended periods. They can offer higher growth potential, even if they're more volatile.
So holding VTI means you don't miss out if small companies have a great run. You get exposure to that entrepreneurial side of the economy, too.
Exactly. You own the whole haystack, not just the biggest needles. And, of course, Bogle's legacy is stamped all over VTI when you look at the cost.
Ah, yes, the cost, the crucial part.
The expense ratio for VTI is, frankly, astonishing. It's currently 0.03%.
0.03%.
Yeah. So if you have $10,000 invested in VTI, Vanguard charges you $3 a year.
$3 to own pieces of over 3,500 companies.
It's incredible. That's Bogle's philosophy in action. That ultra-low cost is a massive guaranteed advantage over decades.
All right, let's switch gears to the other side of our Boglehead portfolio, the 60% allocation to BND, Vanguard Total Bond Market ETF. This is the anchor, right? The stability piece.
That's its job. BND isn't designed for high growth like VTI. Its main goals are capital preservation, generating some steady income, and crucially, having low volatility, especially compared to stocks.
It's the part you hope holds steady or even goes up when your stocks are tanking.
Historically, that's been its key function. In a classic portfolio rebalancing strategy, if stocks crash, you'd sell some of your stable BND and use that cash to buy more stocks while they're cheap. BND provides the dry powder.
But as we said, this is the component causing all the anxiety right now. So we need to really understand what's inside BND and why it reacted the way it did to rising interest rates.
Okay. BND tracks a very important benchmark index, the Bloomberg U.S. Aggregate Float Adjusted Index. Most people just call it the AG.
The AG. Okay, what does that cover?
It represents the broad U.S. investment-grade taxable bond market. That investment-grade part is really important. Meaning it only holds bonds from issuers considered very likely to repay their debts. High-quality, relatively safe debt. Think U.S. government bonds, high-quality corporate bonds, certain types of mortgage-backed securities guaranteed by government agencies.
How diversified is it? How many different bonds are in there?
It's massive. Around 17,000 different bonds are currently in the index and thus in BND.
17,000. Okay, that's huge diversification too.
Absolutely. It holds a lot of U.S. Treasuries, which have basically zero default risk, then a big chunk of corporate bonds from stable companies, and those mortgage-backed securities. But what it doesn't hold is also key.
Which is?
High-risk junk bonds. BND deliberately avoids bonds from companies that are financially shakier, the ones rated below investment grade. Sticking to investment grade is core to its identity as a safety asset.
Okay, so if it holds 17,000 relatively safe bonds, why did its price fall so much when the Fed raised interest rates? This is the key point people struggle with. Let's talk duration risk.
Exactly. This is crucial. Bond prices and interest rates move in opposite directions. It's like a seesaw.
Okay.
When the Federal Reserve raises interest rates, new bonds being issued start offering higher interest payments, higher yields. Let's say new bonds are paying 5%.
Right.
Well, suddenly an older bond already out there that only pays, say, 2% looks much less attractive.
Yeah. Why would I want the 2% one if I can get 5% on a new one?
Precisely. So for anyone holding that old 2% bond to be able to sell it, its price has to fall. It has to drop low enough so that the fixed 2% payment represents a competitive yield compared to the new 5% bonds. This sensitivity of a bond's price to changes in interest rates is called duration risk.
So the value of BND fell not because 17,000 companies were suddenly about to go bust,
Not at all. Credit quality was mostly fine.
but because the general level of interest rates went up, making all the existing lower-yielding bonds inside BND less valuable on the open market.
That's exactly it. The risk in BND isn't primarily about companies defaulting. That's credit risk, which it minimizes. It's about interest rates changing. That's interest rate risk or duration risk.
So its core function, that non-correlation with stocks, still supposed to be there, even if it's temporarily painful when rates rise.
That's the theory. Usually, bad economic news hurts stocks, and nervous investors flee to the safety of bonds like treasuries, pushing their prices up. So even with rate risk, that inverse relationship with stocks is its main job. It just hasn't played out perfectly in this recent, very aggressive rate hiking cycle.
And keeping with the Bogle theme, the cost for BND.
Just like VTI, it's an incredibly low 0.03% expense ratio.
Okay, so the Boglehead 40-60 strategy gives you growth from thousands of stocks via VTI, stability from thousands of safe bonds via BND, maximum diversification in both, and all at virtually the lowest cost imaginable. That's the benchmark.
That's the benchmark. Disciplined, diversified, cheap.
All right, now for the part everyone's been waiting for. The numbers, the showdown. We're running a hypothetical simulation.
Yep, taking $1,000 and seeing how it would have grown over a specific, fairly recent, and pretty demanding decade. From the start of 2015 through the end of 2024, so a full 10 years.
And we're comparing our two strategies, the traditional Boglehead 40-60 VTI BND versus this alternative modern mix, 40% VTI, 30% GLD, 30% STRC.
And this time frame is interesting because it includes some strong years for stocks, but also that period where bonds really struggled due to those rising rates we just discussed. It really puts the spotlight on the BND drag. Hashtag tag 3.1 performance data assumptions, the raw inputs.
Okay, before we show the results, we need to be crystal clear about the performance numbers we plugged into this simulation. These are the average annualized total returns for each asset over that specific 2015-2024 period.
Absolutely. Transparency is key here. Let's lay them out.
For VTI, the total U.S. stock market, over that decade, the annualized return was approximately 14.7%. That's based on historical market data.
A very strong decade for U.S. stocks, clearly.
Now for BND, the total U.S. bond market. Over the same period, its annualized total return was only about 1.9%. Again, historical data.
And there it is, that 1.9%. You can see why people started looking elsewhere. That barely kept up with inflation, if at all, during parts of that decade. It was a significant drag on the overall portfolio return compared to VTI.
Okay, now for the components of the modern mix besides VTI. First, GLD, the gold ETF. Its annualized return from 2015-2024 was around 7.9%. Historical data.
Better than bonds, certainly. Gold had some good periods in there, often acting as that inflation hedge people were seeking.
And now the crucial one, STRC, the high-yield proxy. What return did we assume for it?
This is really important. For STRC, we are using an assumed annualized total return of 10.0%.
Okay, pause there. Assumed. Why not historical data like the others?
Well, STRC itself, or strategies exactly like it aiming for that kind of high yield from preferreds or similar assets, might not have a perfect 10-year track record identical to this simulation period, or the specific goal here is to model what an investor choosing this strategy hopes to achieve.
So the 10% is representative of the target or the promise of a high-yield asset like this, the reason someone would choose it over BND's 1.9%.
Exactly. It reflects the investor's high yield assumption. Someone moving from BND to an STRC-like product is doing it because they expect or need something close to double-digit returns from that part of their portfolio. We're simulating the best case or intended case for the modern mix to see if the reward justifies the risk.
Got it. So VTI 14.7%, BND 1.9%, GLD 7.9%, and STRC assumed at 10.0%. Those are our building blocks.
Now let's quickly touch on why someone might construct that modern mix with gold and STRC. What problems are they trying to solve?
Right, BND was giving you barely 2%. That's low income. And maybe not great inflation protection recently.
Precisely. So the modern mix tries to address both. STRC, with its assumed 10% yield, is brought in to replace the income function of BND, but turbocharged.
Get that yield way up.
And gold, GLD, is brought in partly for its potential as an inflation hedge and partly as an alternative store of value, something that might zig when traditional financial assets zag. It offers a different kind of diversification than bonds.
So ditching BND, adding STRC for high income, adding GLD for inflation hedge alternative diversification. That's the logic.
That's the logic behind abandoning Bogle's simple bond allocation. They're trying to engineer solutions to specific recent problems. Now, let's see how it played out in the simulation.
Okay, strategy A first. The classic conservative Boglehead 40-60 blend. 40% in that high-flying VTI, but weighted down by 60% in that low-returning BND. What was the overall result?
Well, you blend 40% of 14.7% with 60% of 1.9%. The math gives you an average annual return for the Boglehead portfolio over this decade of about 7.02%.
7.02%. Okay. Not terrible, certainly positive, but definitely held back by the bonds. It prioritizes stability, diversification.
Absolutely. It did its job according to Bogle's rules: capture market returns cheaply and safely, minimize volatility compared to an all-stock portfolio. But yes, that 7% feels modest compared to VTI's nearly 15%.
So our initial $1,000 investment growing at 7.02% per year for 10 years, what does it end up as by the end of 2024?
That $1,000 grows to approximately $1,907.
Okay, so it nearly doubled. Solid, safe, exactly what it was designed to do. Capital preserved, modest growth achieved, low cost, maximum diversification. Now, the challenger. Strategy B, the modern mix. Same 40% in VTI, but instead of BND, it has 30% in GLD gold and 30% in STRC, the high yield assumption. This one prioritizes higher returns.
Right, so now we're blending 40% of VTI's 14.7%, 30% of GLD's 7.9%, and 30% of STRC's assumed 10.0%.
Yeah.
Run those numbers.
Yeah.
The average annual return for the modern mixed portfolio comes out significantly higher, approximately 11.25%.
11.25% compared to just over 7% for the Boglehead portfolio. That's
Yeah.
a huge difference, over 4 percentage points more per year.
It's a dramatic difference in annual performance during this specific decade.
So what did the initial $1,000 grow to in this portfolio?
That $1,000 invested in the modern mix, compounding at 11.25% annually for 10 years, grew to approximately $2,913.
Okay, let's put this side by side. Boglehead 40-60 ended at $1,970. Modern mix ended at $2,913.
That's right.
That's $943 more, which means the modern mix generated almost 50% more wealth over this particular 10-year period.
50% more money. That's the number that jumps out. That's the siren song.
This is exactly why people are having this conversation. Why wouldn't you switch, looking at these numbers? It's incredibly tempting. More than tempting, it seems like the obvious financial choice based purely on this result.
It absolutely seems like it. The financial temptation is immense. But this is precisely the moment where Jack Bogle, if he were here, would slam his fist on the table.
Probably. Why?
Because he'd say, you're only looking at the reward and completely ignoring the risk you took to get it. He'd argue that true investing isn't just about maximizing returns, it's about managing the risk of ruin, the potential for catastrophic loss. And that leads us directly into the critical risk analysis. Hashtag 3.4, the critical credit risk conundrum.
Right. We have to pivot now. Forget the tempting returns for a moment and focus on the risk, particularly the risk embedded in that STRC component, which drove so much of the modern mix's outperformance.
This is where the philosophical difference becomes a chasm. The entire extra return, that 50% more wealth, hinges almost entirely on replacing safe, diversified B&D with gold and, more importantly, that single high-yield security, STRC, delivering its assumed 10% return.
Let's revisit that diversification contrast again, because it's stark. BND.
BND holds 17,000 different bonds, overwhelmingly investment grade, backed by the U.S. government or stable corporations. The risk of losing your principal due to any single bond defaulting is practically zero. The main risk, as we discussed, is interest rate risk, which hurts prices temporarily, but doesn't usually destroy capital permanently.
Okay. Now, STRC. Remind us what it is again.
It's not a fund holding thousands of bonds. According to the source materials description, it's treated here as a preferred stock from a single company strategy, Inc.
A single issuer. And it's preferred stock, not a bond. What's the significance of that?
Preferred stock is kind of a hybrid. It pays a fixed dividend like a bond pays interest. That's why it could be a bond proxy. But, and this is crucial in the company's capital structure, preferred stockholders rank below bondholders.
Meaning if the company gets into trouble, goes bankrupt.
The bondholders get paid back first from whatever assets are left. Then, if there's anything remaining, preferred stockholders get paid. Common stockholders are last in line.
So preferred stock is inherently riskier than the bonds of the same company?
Yes. To compensate investors for taking that lower place in the repayment queue, preferred stocks have to offer a higher dividend yield than the company's bonds. That's part of why we could plausibly assume a 10% return for STRC, much higher than B&D's yield.
Okay, so it's a single issuer and it's preferred stock. But there was another critical detail about Strategy Inc.'s status.
Right. The source material estimates that Strategy Inc. has a non-investment grade credit status, also known as junk bond status.
Junk status. That sounds bad. What does it mean practically?
Investment grade, like the bonds in B&D, means rating agencies like Moody's or S&P think the company has a strong ability to meet its debt payments. Non-investment grade, or junk, means the rating agencies see it as having a higher risk of default. The company might be more leveraged, more vulnerable to economic downturns, or facing specific business challenges.
Okay, let's piece this together. The modern mix replaced 60% B&D, 17,000 investment-grade bonds with 30% gold and 30% STRC. And that STRC represents a concentrated bet, 30% of the entire portfolio on the preferred stock of a single company that is not considered investment grade.
Precisely. You've swapped massive diversification and high credit quality for a huge, non-diversified single-issuer credit risk on a company with junk status.
That feels fundamentally different.
It's the difference between worrying about the tide rising and falling on your whole fleet, interest rate risk in B&D, versus worrying about your one single cruise liner hitting an iceberg, credit default risk of STRC.
If Strategy Inc. runs into trouble.
If Strategy Inc. faces serious financial distress, a major lawsuit, an accounting scandal, getting crushed in a recession, whatever its ability to pay that preferred dividend could disappear. And the value of that preferred stock could plummet, potentially towards zero.
And since it's 30% of the modern mix portfolio?
A failure of that single holding could be catastrophic for the entire portfolio. It could wipe out years of that outperformance, potentially leaving the investor worse off than if they just stuck with the boring Boglehead approach.
So I can hear the defense, though. Okay, there's risk, but I need that 10% yield. Bogle's 7% total return isn't enough to live on, especially with inflation. His rules are old news.
What's the Boglehead counter-argument?
Bogle's rebuke would be swift and brutal, I think. He'd say you're fundamentally misunderstanding the purpose of that 60% allocation.
Which is?
It's supposed to be the safety allocation, the ballast. Its job isn't primarily to generate high returns, it's to provide stability, non-correlation to stocks, and preserve capital, especially during crises. He'd say if you want higher returns and are willing to take more risk, put more in VTI, increase your stock allocation. At least there, the risk is diversified across 3,500 companies.
Exactly. Don't take concentrated high-risk bets in the part of your portfolio that's meant to be your bedrock. By putting 30% in a single non-investment grade preferred stock, you've introduced the potential for permanent capital loss right into your safety net.
And the scenario where that risk materializes is often exactly when you need the safety net most during an economic downturn. Junk-rated companies are more likely to struggle then.
That's the nightmare scenario. Stocks crash, the economy tanks, and your STRC holding also crashes because Strategy Inc. gets into trouble. Your cushion deflates at the exact moment you need it to inflate. The correlation flips negative when you least want it to.
So you're not really comparing 7% roses, 11% returns anymore. You're comparing a strategy with minimal risk of permanent principal loss in its bond allocation versus one with a significant concentrated risk of a 30% wipeout due to a single company's failure.
That's the crux of it. From a Bogle perspective, that 11.25% return isn't free money. It's the premium you earn for taking on massive, non-diversifiable credit risk in the worst possible place your stability allocation. The modern mix is essentially making a large, speculative bet with foundational capital.
And for many investors, especially retirees, The peace of mind knowing that 60% of their portfolio is in ultra-safe, diversified BND might be worth far more than the potential extra return from taking that concentrated STRC risk.
It's about sleeping at night. The modern mix might outperform most of the time, maybe even 9 years out of 10, based on our simulation. But that potential 1 year of catastrophic failure makes it fundamentally unsuitable for the kind of conservative, long-term investor Bogle was championing.
It really boils down to a philosophical choice. Are you optimizing purely for potential return, or are you prioritizing the certainty of capital preservation first and foremost?
The simulation showed the lure of the return, but the risk analysis shows the potential devastating cost. Hashtag ad outro.
Wow. Okay, that was quite a journey through those two strategies. Let's try and wrap this up. The core tension is pretty clear now.
Yeah, on one hand, you have the traditional Boglehead 40/60 approach.
Yeah.
We use VTI and BND. It's built on rock-solid principles. Ultra-low cost, massive diversification.
In our 10-year simulation, it delivered a respectable, if maybe unexciting, 7.02% average annual return. Turned $1,000 into about $1,970. It minimized controllable risks like cost and single stock blowups.
On the other hand, you have the modern mix, 40% VTI, 30% gold GLD, 30% high-yield proxy, STRC, by ditching the diversified bonds for gold and that high-yield assumption.
It achieved a much higher calculated return in our simulation, 11.25% annually. Turned $1,000 into over $2,900. It's nearly 50% more wealth over the decade. Very tempting.
And it's a huge but, that outperformance came entirely from swapping diversified safety for something else. Gold, which has its own volatility, and more critically, STRC.
Which, in our analysis based on the source material, represents a massive 30% bet on the creditworthiness of a single non-investment grade company's preferred stock.
It introduces a concentrated, potentially catastrophic credit risk right into the heart of the portfolio stability sleeve. It completely violates Bogle's core tenets of diversification and prioritizing safety in your defensive assets.
It forces a really tough question about what you want that non-stock part of your portfolio to actually do. Is it purely for yield, or is it for crash protection?
The Boglehead answer is clear. It's for protection and stability, achieved through diversification and quality. The modern mix approach seems to prioritize yield above all else in that slot, accepting significant concentration risk to get it.
Which leads us to a final thought for you, the listener, to maybe mull over, building on everything we discussed today.
What is the true cost? Not the expense ratio cost, Bogle taught us about that, but the cost in terms of maybe emotional stress, sleepless nights, and the potential for real permanent capital loss. What's the true cost of chasing that extra 4% annual return, that nearly 50% higher outcome over a decade?
Especially when achieving it means relying so heavily on the financial health of one single company, one that isn't even considered investment grade. It really frames the choice starkly. Safety versus speculation.
That risk-adjusted calculation, thinking about the potential downside, not just the upside. That's the real homework for anyone thinking of deviating from the simple, diversified Boglehead path. Compounding returns are powerful, but surviving to let them compound is arguably even more important. Diversification helps guarantee survival.
Absolutely. And look, we know this is a complex area, and there are many viewpoints. Our goal here is always to build a conversation, cover all the angles.
Definitely.
So if you've done your own research on this, maybe you've looked into other bond alternatives, or you have specific data on the long-term risks of preferred stocks like STRC, or maybe different ways to use commodities like gold, please share it.
We genuinely want to see it. If you feel we missed a key strategy, a crucial piece of data, a different perspective,
send us your sources. Drop web links, documents, articles, your own analysis, whatever you have, into the comments section wherever you're listening to this.
we read them, and it helps us make these deep dives even better and more comprehensive. We want this to be a dialogue covering every point of view.
Couldn't agree more. We look forward to seeing what you've uncovered.
Yeah, should be interesting.
Until next time, keep digging.